Hello everyone, welcome to lecture number 4, last lecture of interim financial reporting. We are going to cover the remaining theory aspects of this chapter, and in all these theory aspects, major point going to be taken into consideration is integral approach and discrete approach. We have already seen that generally for all the incomes and expenses the company applies discrete approach, that is every quarter is treated independent from other quarters. Very marginally transactions, very specific transactions like income tax only, we apply integral approach where we take weighted average effective tax rate. Otherwise we generally apply discrete approach only. All of you take out page number 3 of your study material. In that you will find the form and contents of interim financial statements. See, an interim financial report can contain either a complete set of financial statements or a set of financial statements, cancel that, or a set of financial statements, or a set of condensed financial statements. So underline either complete or condensed. Okay, all of you underline either complete or condensed. So what is this complete and condensed set of financial statements? Let us understand it first. See, complete set means if an enterprise opts to prepare and present a complete set of financial statements in the interim financial reporting, it should be prepared in the same format and as per the contents and requirements of annual financial statements. Means as we do it in annual financial statements, okay, as we do it in annual financial statements, profit and loss statement, balance sheet, cash flow statement, additional explanatory notes, okay, appendixes attached at the end stating the additional explanatory notes. So all those complete sets will be made in interim financial statement, quarterly basis also exactly same manner as you make it in annual financial statements. Now when we talk about condensed set, then a condensed interim financial reporting should contain the following minimum information: headings and subtotals that were included in the most recent annual financial statements. Means if in the last year's annual financial statements you have included shareholders funds, non-current liabilities, current liabilities, you'll include those headings. Subtotals means within shareholders funds, share capital and reserves and surplus was there. Within non-current liabilities, suppose we had only long-term borrowings, so you can include only long-term borrowings, no need to include other non-current liabilities and long-term provisions. So headings and subtotals that were included in the most recent annual financial statements have to be included. Selected explanatory notes are to be included only, not all explanatory notes. Selected notes which are necessary for the shareholders to understand the financial statements. Okay, only selected explanatory notes are to be included which are necessary for the shareholders to understand the quarterly financial statements. Additional items or notes, if they are missing and its absence makes the interim financial report misleading. So if any additional notes are to be included and you find that if that information is not given, then shareholders will interpret the financial statements in a wrong manner, then that additional information should also be given. For example, revenue from operations are less in quarter 1. Now why they are less, you can make an additional note that this is a seasonal business in nature and the main seasons are quarter 3 and quarter 4. So therefore the sales or revenue from operations are less in quarter 1. So this type of additional notes, if you don't put it, then it will make the interim financial report misleading. They will interpret that it's a loss-making business. It will result into wrong interpretation of the business if you don't include such notes. Basic and diluted earning per share for the interim period as per AS 20, not to be annualized on the face of profit and loss statement. So as you find basic EPS and diluted EPS, okay, as you find basic and diluted EPS, profits attributable to the equity shareholders divided by weighted average number of shares, as you find it in annual statements, same way you'll find it in quarterly statements, and you'll report that also in the condensed set of financial statements. So complete set means exactly same way as you do it in the annual financial statements. Condensed set means you'll include headings and subtotals which were included in the most recent annual financial statements. selected explanatory notes only which are necessary for the understanding of financial statements. Any additional note may be given, which if you don't write it, then that may lead to misunderstanding of the financial statements, and basic and diluted earning per share on quarterly basis. Going further, same page 3 of study material, minimum disclosure of notes. What are the minimum disclosures of notes to be made? We will understand them first, then I'll give you a shortcut also to remember these disclosures. So be attentive everyone. Following minimum disclosure of notes and explanatory statements should be made. 1. A statement that same accounting policies are followed in the interim financial statement as were followed in the most recent annual financial statement. So whatever accounting policies you have followed in the last financial statement, for example, if you are providing depreciation by straight line method, then that is an accounting policy. For example, if you are doing inventory valuation by first in first out method, FIFO method, then that is an accounting policy. If these policies have been changed, a description of the nature and effect of the change. So if you are following the same accounting policy, you are following straight line method itself, you are following FIFO method itself, then you have to make a statement in the interim financial report that you are following the same accounting policies as were followed in the last year. If you are changing it, then the description of the nature and effect of changes to be given. Then you have to mention that you have changed, suppose from straight line method to reducing balance method. What is this nature? From straight line to reducing balance method, and what is its effect? Means the depreciation increases or decreases by what amount by this change. That effect has to be disclosed. So very first disclosure is regarding the accounting policies. What we have to disclose regarding the accounting policies? If we are following the same accounting policies, we have to mention a statement that we are following same accounting policies. If we have changed the accounting policy like SLM to RBM, FIFO method to LIFO method, then we have to mention that this method has been changed, this policy has been changed. We have to describe the change and we have to describe its effect also. Second disclosure. Description about the seasonal assets, liabilities, equity, net income and cash flow. So as I said in the previous slide also, that you have to write that explanatory notes, that why in quarter 1 the sales or revenue from operations are less because of the seasonal nature of income. So you have to give the description of not only that seasonal nature of income of sales, but if there are any seasonal assets, seasonal liabilities, seasonal equity, seasonal net income, seasonal cash flow, description of all such seasonal items has to be given in the disclosure. Next, effect of change in estimates. So if there is any estimate which we have changed compared to the last year, for example, last 10 years, we are providing bad debt reserve at the rate of 5%. In this quarter, if we have provided 8% or 7% or any different rate, lesser rate also 3% or 4%, then what will be the effect of that change in estimate we are supposed to make? Estimate is made regarding the people who will retire, gratuity, pensions, all these are based on estimates, leave salaries. If there is any change in estimate anywhere, then the effect of that change in estimate has to be disclosed. Third, change in debt and equity through issuance, repurchase and repayments. Means change in debt and equity means suppose you have issued debentures in this quarter and because of that the debentures have increased. You have issued equity shares, preference shares in the quarter and because of that equity shares have increased. Okay, through issuance. Repurchase means you have bought back debentures in the open market, you have done buyback of equity shares, you have done redemption of preference shares, repayment, redemption of debentures. So if the debt and equity amount has changed by issuance, repurchase or repayments or by any reason, then that changes are to be disclosed. You mention that in this quarter you issued the debentures, you redeemed the debentures, you bought back the equity shares, you issued preference shares. You mention that as a disclosure. Then details of dividend payment. So generally companies give annual dividends. If they have given interim dividend based on quarterly profits, then the details of that dividend payment is also to be disclosed. Segment revenue, segment results for business segment or geographical segment, whichever is the primary basis of the reporting entity. In the segment reporting chapter, we have studied how to make a segment report. So that segment revenue is to be disclosed, segment results is to be disclosed, which may be business segment or geographical segment, whichever is the primary reporting segment for the entity, which may be based on your parts of different products, then business segment, different areas, then geographical segment, whichever is your primary reporting segment, Based on that, the segment revenue and results should also be disclosed. Then material event that has occurred after the end of interim period. Now see, first interim period April, May and June. The reporting of that will not be done on 30th June. Okay, you'll make the quarterly final accounts and then there'll be some time gap, maybe week or 10 days gap between the finalization of accounts and reporting. So suppose the finalization of accounts is done on 30th June but the reporting is done on 10th of July. Then between 30th June and 10th of July, if any important event has taken place, maybe you have entered into a contract with another company which will increase your sales in the coming quarters. Maybe you have come across a suit against the company which may incur big losses in future in the court of law. Any important event that has taken place on the date of between the date of finalization of accounts and reporting period, then such events should also be disclosed to the shareholders. Effect of change in the composition of enterprise during the interim period. Change in composition includes business combination, acquisition, restructuring, disposal of subsidiaries. So, if the composition of enterprise has undergone a change, you have done amalgamation, if you have done reconstruction of your business, or if you have acquired any other subsidiary company, you are a holding company, you have acquired any other subsidiary company, all such effects of change in composition must be disclosed to the shareholders in quarterly interim financial reports also. Material changes in contingent liabilities since the balance sheet date. So contingent liabilities, like I said, worker have filed a suit against the company, it is disputed in the court of law, and if there is any change in the amount of that contingent liability, then that material change should be disclosed to the shareholders. Now, how will you remember these disclosures? All please see complete disclosures. Write down this in your study material. How will you remember the 9 disclosure items? Short form is all please see complete disclosures. First letters are important, A, T, in C entirely SEE, therefore I have written in capital letters C and D. Now, A and P stand for accounting policies. Okay, all please AP stand for accounting policies. So disclosure number 1, what would we study? If same accounting policy is followed, a statement has to be written that same accounting policy is followed. If it is changed, then the description and effect of change is to be given. Then S stands for seasonal. Now after AP, S, E, C, D all will stand for 2 points. S, E and C and D will all stand for 2 points. Remember this. So S stands for which 2 points? Seasonal. That is point number 2. Seasonal assets, liabilities, income, expense, cash flow, equity, everything is to be disclosed. As well as it stands for point number 6. S means segment. Segment revenue and results as per the basis of business or geographical segments must be reported. Same way, E also stands for 2 points. Point number 3, estimates. If there is any change in estimate like BDR, gratuity, pension, that is to be disclosed. And again, E stands for 7th point, material event. Any important event taking place between the finalization of accounts and the reporting date must be disclosed. Then C stands for again 2 points, point number 8 and 9. Composition means amalgamation, reconstruction, holding and subsidiary. Any such change in composition must be disclosed. And 9th point, any contingent liabilities change must be disclosed. Then D again stands for 2 points, that is point number 4, debt and equity. If there is any change in debt and equity because of issue of debentures, repurchase or repayments, then that should be disclosed. And point number 5, if any quarterly dividends are paid, then that must also be disclosed. So once again, how will you remember the shortcut of all the 9 disclosures? The short sentence you'll remember is all please see complete disclosures. Disclosures, all please see complete disclosures. All please AP accounting policies. S stands for which 2 points? Seasonal and segments. E stands for which 2 points? Estimates and events. C stands for which 2 points? Composition and contingent liabilities. D stands for which 2 points? Debt and equity and dividend payment. This is how you can remember all the 9 disclosures. Moving further, if you look at page 4 of study material, you'll find the point of materiality. Now, in all the remaining points, we have to decide, do we follow discrete approach or integral approach? We already know that 99.99% cases, majority places, we follow discrete approach only. Only 1 point will come across where we are going to follow integral approach. Tax expense is already there. Beyond tax expense, in addition to tax expense, there will be 1 more point where we will be following integral approach. Everywhere else we are going to follow discrete approach. So materiality means the overriding objective is to ensure that an interim financial report includes all information that is relevant to understanding an enterprise financial position and performance during the interim period. So materiality means all the important information which is necessary to be known to the shareholders must be disclosed. Then seasonal or occasional revenue. Discrete approach. Discrete means if it is seasonal, even if you face loss in one quarter, but if it is not the revenue of that quarter, you will not take it. And whichever quarter the revenue occurs, that quarter only you are going to take it. As explained earlier, the discrete view is taken for measurement and recognizing the revenues. Therefore, such revenue are recognized when they occur. Example, interim dividends, royalties, and government grants. Additionally, some enterprise consistently earn more revenues in certain interim period of a financial year than in other interim periods. Example, seasonal revenues of retailers. Such revenues are recognized when they occur. I gave you the example of air conditioning business earlier. That in air conditioning business, quarter 1 and 2, there will be more sales. Maximum sales in quarter 1, April, May and June. Lesser in July, August, September. Still lesser in October, November, December, and least in January, February, March. So anyway, as per discrete approach, whichever quarter the revenue occurs, that quarter you are going to report. Further, if you go, you'll find changes in estimates. Here also discrete approach, changes in estimate. Just now I discussed with you in the disclosure. If BDR percentage is changed from 5% to 8%, that must be disclosed. Amounts of income and expenditure reported in the current interim period will reflect any changes in estimates of amounts reported in the prior interim period of the financial year. So even prior interim period, if any estimates change and it affects the current financial year and quarter, that has to be disclosed and restated. Restated means written with the correct amount again. The amount reported in the prior interim period is not retrospectively adjusted. However, any significant change in estimates may be disclosed. Then changes in accounting policy. This also we discussed in the disclosure. If from SLM you have changed to RBM, then whatever is the effect of change, that has to be disclosed. If there is any change in accounting policy within the current financial year, effect of change in accounting policy is applied retrospectively, and therefore prior interim periods financial statements should be restated to include the effect of change. So what they are saying is we make interim financial statements from year to date basis. Year to date basis means when you submit the information of quarter 1, you submit only quarter 1. But when you submit the information of quarter 2, you submit quarter 2, which is July, August, September, as well as you submit on year to date basis. Means two things are reported. Quarter 2 and then April to July, August, April to September again. Two things are reported in the financial report. Second quarter, July, August, September, and one more statement is made from April to September again, which includes quarter 1 also and quarter 2 also. So if you have changed any accounting policy in quarter 2 from SLM to RBF, say depreciation, then when you make April to September, you will change that in April, May, June also, and the complete effect will be restated and represented again in that financial statement. Okay, you can listen to this what I have explained once again if there is any confusion. Further, if you see on page 4 of study material, you will find costs incurred unevenly during the year. Costs incurred unevenly during the year means costs that are incurred unevenly during an enterprise financial year should be anticipated or deferred for an interim reporting purpose if and only if it is also appropriate to anticipate that, cancel the word order, that type of cost at the end of financial year. See, many costs are incurred unevenly during the year. For example, if I say donations, it is not necessary that, see, salaries, interest expense, these all are evenly during the year. Every month the amount remains same. But donations you make sometimes in quarter 2, sometimes in quarter 3, sometimes you may not make the donation. So what will you do with such expenses which are incurred unevenly during the year? You just remember discrete approach. Discrete approach means whatever you do in one full year is treated separate from the another financial year. Same way, one quarter is to be treated separate from another quarter. So if you are making the accounts for full year, and in that full year, if you defer any expense, means you write off some part in current year and some part in further years, then you can do that in quarterly financial statements also. Means even in quarterly financial statement, you can defer that and take it to quarter 2, 3 and 4 if you are doing the same in the entire year. But if you don't defer any cost in the entire, like donation, you incur any expense of donation in current year, you take it in current year only. So if you incur donation in quarter 2, you will take it in quarter 2 only. But discount on debentures we write off. Over the period of debentures. So in annual financial statements also, what do we do? Discount on debentures. we write off some amount in current year and next, let us say 4 or 5 years, that you will follow in quarterly statement also. You'll write off the amount in quarter 1, 2, 3 and 4, means you'll defer it as you do it in the financial statements at the end of the year. So if any cost is incurred unevenly during the year, if in the yearly financial statements you can defer it to coming years, then in quarterly financial statements also you can defer it to coming quarters. If in yearly financial statements you cannot defer it to the coming years but take it in that year only, then in quarterly financial statements also you take it in that quarter. Okay, so whatever principle you follow in yearly financial statements, same is to be followed in quarterly financial statements. Further, major planned periodic maintenance or overhaul. So periodic maintenance overall means big repairing expense. Okay, the cost of major periodic maintenances overall or other seasonal expenditure that is expected to occur late in the year is not anticipated for interim reporting purpose unless an event has caused the enterprise to have a present obligation. The mere intention or necessity to incur expenditure related to the future is not sufficient to give rise to an obligation. So, if there is any obligation arising, there is event taking place which makes it sure that this expenditure is going to come now in the next quarter or in the next year, then you make a provision for the same. So, for example, let us say that right now the third quarter is going on in which the compressor of AC is not working. Now right now we know that it's winter season, so you may not replace the compressor right now, you may replace it in the next year in quarter 1, but we know that this event has taken place and the expenditure is sure going to be incurred. You make a provision of that in quarter 3 itself. You make a provision of the same in quarter 3 itself, though it may come in the next year. So as you do in yearly financial statements, if you are sure that any amount is going to be incurred in the next year, you start making the provision for the same. Same way in quarter also, if you are sure that that amount is going to be incurred in the next quarter, you start making provision for the same. But until any such event has taken place, you don't estimate that this big expenditure will come in the next quarter and you don't create a provision for the same. If anything makes you believe, any event makes you believe that this expense is going to be incurred in next quarter, then you make the provision for that in current quarter also. Further, intangible assets. An enterprise applies the definition and recognition criteria for intangible assets in the same way in interim period as in annual period. So as you record the intangible assets in the yearly financial statements, same way you recognize it in quarterly financial statements also. An enterprise should not defer the cost of an asset in an interim balance sheet in the hope that the recognition criteria will be met later in the financial year. So if you are sure that in this quarter the recognition criteria are met, then you record it. If they are not met, then that is not to be recorded. Discrete approach. You remember that one quarter and other quarter is like India and Pakistan. Okay, they will never come together. So whatever comes in this quarter has to be taken in this quarter. Contractual or anticipated price changes. An enterprise anticipates volume rebates. Now underline this is important point. Volume rebates or discounts and other contractual changes in the prices of goods and services in interim period. Underline volume rebates or discounts and underline in the interim period if it is probable that it will take effect. Means, see, in the yearly financial statements also, what do? If you expect that in the you are having volume rebates or discounts. Volume rebate or discount means you have 5-10 such customers who purchase the quantity in bulk, means you know that every time they come in this quarter and purchase the quantity in bulk and we are going to give them the discount. You already know this is going to happen, then you make a provision for that. That you do in quarterly financial statement also. In quarter 2, if you know that bulk quantity discount is going to take place, then you take that in quarter 1 also and quarter 2 also. However, it does not anticipate discretionary rebates and discount because the resulting liability would not satisfy the condition of recognition. Discretionary means if any person comes, negotiates with you, bargains with you, then you give him discount. He is not purchasing in bulk quantity. Such discounts cannot be provided in advance. But if we know that this every year in quarter 2, one customer comes, it's a repeated order and he takes in bulk quantity and we give him discount, then even in quarter 1, though that discount is not taking place, you can make a provision for the same. Only if it is repeated volume quantity or discount. But if it is discretionary basis, some people you give the discount on the basis of terms and relations when asked for the discount. Such discounts should not be taken in respective quarter until and unless they occur. It means here we follow which approach? Integral approach. Why integral approach? Because in quarter 1, we take the discount of quarter 2 also. And we make a provision because we know it's a repeated order. Quarter 2 it is going to take place, so in quarter 1 also we make the provision of the same. So if you remember in the beginning of this lecture I told you 99.99% places we follow discrete approach. Other than tax there is one more place where we follow integral approach. This is the one. Which one? Discounts and rebates. In discounts and rebates we follow integral approach and we take the discount in quarter 1, 2, 3 also, even if it is related to quarter 4. If it is short, that bulk quantity or discount is going to be given in that particular quarter. Further, you look at page number 5 of your study material now, inventories. An enterprise measures interim financial reporting by the same practices, as at the end of the financial year. However, to save expenses and time, enterprise often use estimates to measure inventories at interim dates to a greater extent than at an annual reporting date. In annual reporting date, we count the inventory, we make a proper valuation, but every time counting of inventory every 3 months may be very difficult process. So estimates may also be used, but the same principles and practices must be followed. As you do in annual financial statements, you have to follow in quarterly financial statements also. So again, discrete approach. Which approach? Discrete approach. Net realizable value of inventories. An enterprise determines the net realizable value of inventories by reference to selling price and related costs to complete and sell the inventories. It reverses a written down to net realization value in subsequent interim period as it would be at the end of its financial year. So as we do in the end of the financial year, if the value has gone down, we make a provision for that for the closing stock and we reverse it in the beginning of the next year. Same way you can do in quarterly also. In quarter 1, if the value has gone down, you can take cost price or market price, whichever is less. And in the quarter 2, the same may be reversed if the market price has again gone up. So discrete approach, India, Pakistan, 1 quarter different from second quarter. Depreciation and amortization, again discrete approach. Depreciation and amortization for an interim period is based only on assets owned during that interim period. So in quarter 2, if you don't have an asset, you cannot provide a depreciation for the same. If you are going to purchase in quarter 3, its depreciation will come in quarter 3 only. It does not take into account assets acquisition or disposals planned for later in the financial year. Gratuity and other defined benefit schemes. So gratuity also discrete approach. An enterprise should estimate provisions in respect of gratuity and other defined benefit schemes for an interim period on year-to-date basis by using the actuarially determined rates. Actuarially means actuary is a person who estimates how many people or employees will retire in which particular year. So based on that determined rates at the end of the prior financial year. This should be adjusted for significant market fluctuation since that time and significant curtailments or other significant one-time events. Actually, this point you'll understand in detail in the next chapter, employees benefit expenses. So right now you just remember, even in gratuity and other defined benefit schemes, we follow discrete approach only. Means we make the provision every quarter as we make it in the yearly basis. So what you do it in the whole year, you have to do it in the same quarter. Though gratuity may become payable after 20 years, but every year do you make a provision for gratuity or not? So again, though gratuity may not be payable in quarter 1, you'll create a provision in quarter 1, quarter 2, quarter 3 and quarter 4 also. Year-end bonuses. Now year-end bonuses, again, an enterprise anticipates a bonus for interim reporting period purpose only if A, the bonus is legal obligation. Legal obligation means as per the Industrial Disputes Act, as per the Workers Act, if bonus has to be paid, it's a legal obligation. So even if we are going to pay the bonus in the month of March, in the first quarter, April, May and June, you have to make a provision for that. Why make a provision for that? Because it's a determined expense, 100% short expense. So in quarter 1, whatever is the bonus related to that 3 months will be provided and kept aside. Or an obligation arising from past practice for which the enterprise has no realistic alternative but to make the payments. Every Diwali, suppose you give bonus to your workers, you know is this Diwali also, you will have to give the bonus to the workers. So in April, May and June also you will make a provision for the same. And second condition, a reliable estimate of the obligation can be made. Then provisions. An enterprise applies the same criteria of recognizing and measuring a provision at an interim date as it would at the end of the financial year. The facts subsisting at the balance sheet date determine whether there exists a present obligation that meets the definition and recognition criteria of a liability or not. In short, whatever way you make the provision at the end of the financial year, same rules are to be followed for every quarter also. So if you make any provision at the end of the financial year, that provision you have to make in every quarter also. Now, application of interim financial results. Issue. What is the issue in application of interim financial results? Whether AS 25 is applicable to interim financial results presented by an enterprise pursuant to the requirement of a status or regulator. For example, quarterly financial results presented under clause 41 of the listing agreement entered into between stock exchange and listing enterprise. What they are asking you is the issue. The issue means there is a problem. As per SEBI's clause 41, if quarterly financial results are to be presented, then do we have to follow AS 25 also in that financial statement? There is a problem. What is the problem? If any company is listed in stock exchange, they have to follow SEBI guidelines. As per SEBI guidelines, clause 41, they have to make quarterly financial results. So if the company, see, there are two things. If you follow SEBI, then do you have to follow AS 25? If you follow AS 25, then do you have to follow SEBI? You remember, they are father and son. Father and son means son will never disobey the father. That way, AS 25 will never disobey clause 41. Means whatever is covered in clause 41, same rules and regulations are covered in AS 25 also. So you follow clause 41, you don't follow AS 25. That's perfectly okay. There is no discrepancy between the two. That is what is the consensus. Consensus means decision. How the problem is resolved? As per the consensus, the problem is resolved as per guidance note issued by ICAI, the presentation and disclosure requirements contained in AS 25 should be applied only if an enterprise prepares and presents an interim financial report as defined in AS 25. But here you are not presenting as per AS 25. You are presenting as per clause 41 of listing agreement. So follow that only. AS 25 will not intervene in that, and you are not disobeying any particular AS 25 instructions. Accordingly, presentation and disclosure requirement contained in AS 25 are not required. Underline this. Not required to be applied. Underline this. Not required to be applied in respect of interim financial results which do not meet the definition of interim financial report as per AS 25 presented by an enterprise. For example, quarterly financial results presented under clause 41 of the listing agreement entered into between stock exchange and the listed enterprise do not meet the definition of interim financial report as per AS 25. However, the recognition and measurement principles laid down in AS 25 should be applied for recognition and measurement of items contained in such interim financial reports. In short, what is the problem? Under clause 41 of listing agreement, if you are making interim financial report, do you have to follow AS 25? What is the resolution? You don't have to follow AS 25, just follow clause 41. And the last point, significant differences amongst AS 25, IFRS, IAS 34 and US GAAP, APB 28. Now, what is this AS 25 accounting standard 25? What is this IFRS and IAS 34? That is also on interim financial report. Okay. Indian accounting standards IAS 34 and IFRS 34 is also based on interim financial reports. And what is this US GAAP, generally accepted accounting practices and principles? APB 28, that is also based on interim financial report. What are the differences amongst these? Under US GAAP, interim period is primarily viewed as an integral part. This is important, underline this. Whatever is in pink, underline that in your study material. See, as per AS 25 and IAS 34, majority places we follow discrete approach. But as per US GAAP, they follow integral approach in majority places of the annual period, whereas AS 25 and IFRS AS 34 primarily discrete approaches followed. Under AS 25 and IFRS AS 34 and inventory loss. Now what do we do in AS 25? Inventory loss from market price decline is recognized in the interim period, means whichever period discrete approach, the inventory loss occurs, that period you take it. But in US GAAP, such loss is not recognized if the decline is expected to be restored before the end of financial year. So again, here in GAAP you follow integral approach, but in AS 25 and IAS 34 in inventory loss also you follow which approach? Discrete approach. Next, accounting policies and practices may need modification at interim financial report dates in US GAAP. So in US GAAP you can change the accounting policies and practices, whereas in AS 25 you don't change it, and if you change it the effect is to be disclosed. Whereas AS 25 and IFRS IAS 34 estimates that same accounting policies and practices as followed for annual reporting should be followed for interim period reporting also. So complete chapter is over. All the important theory aspects have also been taken into consideration. Now in the next lecture, we'll start with the next chapter of financial reporting. That'll be all for this lecture. Bye everyone. Take care. See you in the next lecture.